Mark Zuckerberg's Facebook remains a resilient growth machine as Facebook's population closes in on 3 billion people. Through scandals, regulatory pressure, and activist campaigns, the company's revenue and earnings have accelerated at impressive rates. Ultimately, Facebook's two most important constituents, consumers and advertisers, just can't quit the social network. Revenue was up 21% in 2020 to $86 billion, despite pandemic-related issues, including a slowdown in travel advertising. Wall Street expects overall revenue to jump 25% this year to a total of $107 billion. There are plenty of reasons to dislike Facebook. It's facing antitrust lawsuit, it has been blamed for spreading hate speech, and it has confronted repeated criticism of privacy practices. There was a delete Facebook movement in 2018 and a stop hate for profit ad boycott in 2020. Both got a lot of attention, however, neither had an impact on Facebook's bottom line. There could be more controversy and pain on the horizon, but investors know those risks already. What investors need to focus on is the innovation and other assets hidden within the social network giant, including Instagram, e-commerce, messaging, and virtual and augmented reality. Those opportunities could get more attention in years to come, sending the shares significantly higher. Facebook executives have multiple ways to get the stock moving and even higher. Here are the levers at their disposal. First, paying dividends. It starts with the balance sheet. At the year end, the company had no debt and $62 billion worth of cash on its balance sheet. All of that cash could be put to better use, especially since the company has cooled on big deals amid the regulatory pressure facing tech companies. Facebook can easily pay a yield of 1%. That would come to about $8 billion annually. Even a token dividend payment would open up the stock to a long list of institutional investors who previously could not touch it. Plus, it would signal to Wall Street that Facebook was managing its cash in a more investor-friendly manner. Tech companies long ago dispelled the idea that dividends applied only to slow-growing, mature companies. However, Apple stock has returned nearly 600% since it began paying dividends in 2012. Second, let's talk about WhatsApp. Another past Facebook acquisition still confounds investors. Facebook paid nearly $19 billion for the company in 2014. In the US, WhatsApp plays second fiddle to Apple's iMessage, which is installed by default on iPhones. That has become one of the several points of contention between the two companies. But WhatsApp is hugely popular outside the US, where there's a thriving market for the app. WeChat, owned by the Chinese tech giant, is a best example. The segment including WeChat just reported its fourth quarter sales that equaled $4.3 billion. WeChat is lucrative because the parent company, Tencent, has figured out several ways to add money-making features on top of messaging and communication functions, making it a central hub for people's lives. While chat apps don't typically take that approach in the US, Facebook could probably cash in abroad, where most of its users live. Facebook's strategy has long been to grow an enormous user base while developing the product. Once Facebook is happy with both, it then turns to advertising, just like it did with Facebook.com back in 2007. For now, WhatsApp is an option for the future, not the near-term source of profit. Third, building social commerce. During the pandemic, people have flocked to online shopping, not a traditional area of strength for Facebook, but that is changing. As Facebook's users come across new products and brands, either through ads or friends, Facebook has created tools that allow millions of small businesses on its platform to easily sell their products. One of the main offerings, called Facebook Shops, began in 2020. Facebook has more than 1 million active shops and more than 250 million people that interact with these shops every month. Fourth, the Instagram story. When Facebook bought Instagram in 2012, it seemed like an extravagance. Facebook was paying nearly $1 billion for an upstart photo-sharing site with absolutely no revenue. The Instagram deal, however, has been the most telling indicator that the Facebook CEO, Mark Zuckerberg, knows more than the rest of us. No one can doubt that Instagram's impact on the society has been immense. It has hacked the dominance and visual culture and combined it with the power of a billions-strong network. The app has prompted social change, both positive and negative, and influenced construction, film, and visual art. It is an important part of at least 1 billion lives. And lastly, we cannot forget about virtual and augmented reality, which remains one of Facebook's boldest bets, one that has long been a promise than a reality. This year, Facebook is planning to launch its own augmented reality product, a pair of smart glasses designed in partnership with the Italian maker of Oakley and Ray-Ban eyewear. Facebook began testing the prototype last year under the codename Project Aria. Facebook has probably learned from others in the AR space. Alphabet's Google Glass, which had a camera and an integrated display, was an embarrassing failure for the company. Facebook's first product won't include a display, instead using sensors and embedded chips to encrypt and store information on separate servers. For now, augmented reality gives Facebook investors another option on an unpredictable future. While the future may be uncertain, there's nothing unpredictable about Facebook's core business. The company is expected to generate $35 billion in free cash flow next year, up 30% from this year's forecast. The stock price should follow.